Welcome to TheoTrade. This is Don Kaufman. It's February 22nd, 2019, and you are watching the TheoTrade Weekend Update. All right, let's do kind of a quick week in review and then jump into a couple of very key points. Obviously, just the title really of this entire weekend's update, and something I'm going to focus on quite a bit when we get into the charts. I'm actually got have a few slides for you as well, is really a stock that effectively defines the entire marketplace right here, right now. And again, I'm going to mention that here momentarily. Before that, let's get into this, as I said, kind of week in review. So, what did the broader market do much of this week? Well, once again, absolutely nothing. What did we learn from the FOMC minutes? Not much. I mean, we can go on about China. What did we learn about China? Stay of execution there. They're just going to kick the can down the road. What did we learn about Brexit? No, it's probably going to be delayed by about 3 months. Kick the can down the road over there. So again, the S&Ps did, well, a whole lot of nothing. Again, I think a lot of bullish traders would claim a little bit of victory on this front, because the S&Ps closed slightly up. Again, it was a 4-day trading week, so it was a holiday trading week. The S&Ps did migrate to the upside, mildly so. The Nasdaq was largely unchanged, and the reason I said that this week was a whole lot of nothing is specifically because of the financials. If you take a look at the financials, I've talked about this this line in the sand that is literally 2650. Keep that in your head. The XLF specifically at 2650. You know, last week, the XLF closed right around 2647. Where did it close today? This is a Friday afternoon. Pretty much at, well, 2646. So what do you got? You got nothing throughout the course of the week. And volatility, again, kind of continued to contract. But there is one kind of key differential this past week of trade. Not only did implied volatility contract this past week, but some of the historical volatility, that is, actual price movement this week in the S&Ps was kind of dead. I have to tell you, there was a whole lot of trading sessions that went on this week, pretty much all 4 of them, where you sat there and just sat there and nothing, people, absolutely nothing. Then all of a sudden you had a tape bomb. If you've never heard the terminology tape bomb, it's when you get like a political tweet or like news today out of China. We had absolutely nothing going on throughout the course of today's session. You get one little like news blurb about China. The S&Ps sell off by like 8 points in 1 minute, destroying everybody's entire day, only to see it rally back up. Well, that's why we call them, again, tape bombs are everywhere. In fact, you're going to have more tape bombs next week. There's a lot of economic news coming out next week. One other key point to be made before we jump into the charts and some of the slides over here has everything to do with the fact that the bond market started moving with a positive correlation with the equity market. What gives there? No idea. Again, this is in huge contrast to anything we've seen in some of the recent trade. What I'm saying is we had a day where, well, okay, the bonds moved down, the equities moved down. The very next day, the bonds moved up, the equities moved up. You know, typically, okay, they're moving what? Inversely proportional to one another, at least to some degree. Well, later in this week, what did we see? Again, positively correlated bonds and equity markets. That could be a little bit of a shot across the bow, because this started and really kind of kicked in after those FOMC minutes. And as I said a moment ago, we didn't learn a whole lot, okay, about what's going on inside the FOMC by reading through those minutes. Well, the one thing that we, I think, did learn is that the FOMC is just taking a, I don't know what's going to happen. I mean, after having read through, and I read through all of the FOMC minutes, by the way, you're having a little insomnia, you're having a little trouble sleeping over there, that's the way to get it done right there. Read the FOMC minutes. The one thing I think that stuck with me after reading through those minutes, these, again, you know, the Fed right now, they just have absolutely no clue. So they're pausing everything. I mean, that was my big takeaway, is like, listen, the economic indicators, they're all over the place. We know that China's slowing down. We know that Europe's slowing down. There's tariffs. Okay, they were just mounting all of the risks in their discussion and then turning around and say, well, but the U.S. isn't that bad, but at the same time, we're going to pause everything. That was the big takeaway, is they have absolutely no idea. And after having read through that, I guess the only thing that really resonates in my mind is I keep thinking back of like Japan and in the late 90s, and when they went down to zero interest rate, you realize that Japan never got out of that. In fact, Japan now has negative interest rates. So I think our market is apparently turning Japanese now, and we're going to have low interest rates forever. All right. So again, a couple of points to be made. The last point we're going to talk about, and we're going to get into the slide here momentarily, is again, the stock that defines the market. One stock that's actually driving the markets. And in a moment here, I'll give some credit where credit is due. This was actually a quantitative research firm that went ahead and did some homework on this front, which I'm going to present to you momentarily. With that, let's learn a little bit more about the stock that drives this marketplace. To the charts and trades we go. As mentioned moments ago, we're going to talk about what we term the single most important stock in the entire marketplace. Prior to doing so, though, we have to get a little background knowledge in why, one stock, not only defines the market, but is actually driving order flow to the entire market, and literally one individual underlying can, in fact, move markets. So let's get to some of that background knowledge here in this weekend's update. What you're looking at right now on your screen happens to be none other than the S&P 100. I felt that using the S&P 100 is a little bit easier, to distinguish rather than coming in here to the S&P 500. But to make a quick point, all right, we have a product like the spiders. We have a product like the S&P futures. We have a product like the SPX. Obviously, all of these products are basically what, right? They're the S&P 500. All right. So what's the point to be made with that? I just want to give you, for example, if the spider goes up, if the spiders go up, do the S&P futures go up? Of course they do, Does the SPX go up? Well, yes, but the SPX is an options kind of only product. Nevertheless, everything for the most part moves in relative tandem. Now that's easy to kind of discern when it's the spider, the S&Ps, and the SPX, and there's actually computer systems that are tied to these products that move them in relative tandem. By the way, if you're sitting at home and you're watching this right now and you're thinking to yourself, you're like, yeah, I like this idea. Somebody buys the spider and I can jump in and buy the S&P future. This happens sub-second. So when somebody comes in, for example, and they buy S&P futures, this is the S&P 500 futures, immediately the spiders move in relative tandem. When I say immediately, people always ask, well, how long does that effectively take? Well, it was all the way back in 2012. 2012, when the Nasdaq started recording data, in nanoseconds. That's billionths of a second. We're no longer like people talk about like microseconds or like milliseconds. We're way past that now. We're actually talking about nanoseconds of movement. Now, along with the spiders and the S&Ps and the SPX, knowing that these things move in like relative tandem, then we actually come to the S&P 100. And what's the S&P 100? It's the 100 basically largest stocks in the S&P 500. So what happens is if the spiders start to move up, and I'm using the spiders because most people are familiar with it, right? When the spiders start to move up, what are the spiders? Well, they're a basket. They're a basket of, the S&P 500. So what has to happen? The basket has to move in relative tandem nature. So what happens is, again, when a big trade is fired into something like the spiders, let's say somebody goes out, and they turn around and they buy. And I'm just going to give you a really easy example in this case. Let's say they buy, all right, 1 million in, again, 1 million shares in the spiders. And that just bumps the spiders up ever so slightly. By the way, a million shares in the spiders is a big nothing burger, but it's driving the spiders higher. And as the spiders drive higher, that in turn triggers servers, to go out and to buy individual components of the entire S&P 500. Now, again, I'm representing this as the S&P 100 to make it a little easier for this example, But as the spiders move, those orders are fired out instantaneously. Again, literally in billionths of a second. That is actually what we term stat or statistical arbitrage. And what that is it's a primary component, something like the spiders or the S&Ps, those primary components, as they move higher or lower, it moves the entire basket, and again, vice versa. So people then always ask me like, well, what moved first? the old chicken or the egg, okay? Could an individual stock drive higher? Could an individual stock like drive higher or lower, okay, and move the futures markets? And the answer is, yeah, actually, that can happen. And, which is the chicken or the egg? Well, it happens at literally light speed right now, so it doesn't necessarily matter. But yes, okay, individual stocks can drive order flow back into the S&Ps. Now, what are some of your bigger stocks out there? Because everybody's thinking to themselves right now, like, okay, which stock is he going to talk about? What's the stock that defines the market? People always think about like Amazon, right? They think about Apple, okay? What else you got out there that's really big? Microsoft, and you got your Facebook, and we go on and on, okay? These don't even hold a candle, okay, to the stock that I'm about to talk about. And I'm going to show you why here momentarily, right? But it's imperative that we understand just this very simple idea of statistical arbitrage, okay, that markets do have tendency to move in relative tandem. Now, statistical arbitrage sometimes can break down, but I'm going to show you even a more effective version of it. Another version of statistical arbitrage that's being done, okay, is a product like the Dow. Now, okay, I'm gonna minimize that a little bit, but it's a product like, for example, the Dow. So we have the Dow, okay? Then we have the S&P 500, okay? And then, for example, we have, Nasdaq. So there's also an arbitrage relationship, and you can even throw, if you want to get crazy, we could even throw the Russell in here, but I think this is fine. So most of the Dow stocks obviously are going to reside inside the S&P 500. And there's a few Nasdaq stocks obviously that are going to reside in the S&P that are going to reside inside of the Dow. In fact, some of the biggest Nasdaq stocks, they're also some of the bigger, Dow stocks, and some of the biggest Nasdaq stocks, your Amazons, they're some of the biggest stocks inside of the S&P. But the Dow happens to be the most interesting one. Okay, why is the Dow the most interesting one? Okay, because now we're getting down to it. Because there's only 30 stocks inside of the Dow. And if you can actually move these 30 stocks and you can move the Dow, technically if you can move the Dow higher, or lower, you can actually influence the S&P 500. Why is that the case? Because again, there's an arbitrage relationship between these. It doesn't matter, again, how many stocks, It's a matter can you move the Dow? Because if you can move the Dow, there's going to be a relative tandem nature of what the S&Ps are going to do, and what the Nasdaq is going to effectively do. So think about this, because what I'm really getting into is how these large trading firms, shall I call it this, are gaming the system a little bit. And how are they gaming the system? Because they've actually figured this out mathematically, and they're actually driving order flow into one stock, and that one stock is effectively now moving the entire Dow. They move the Dow, it moves the S&P 500, it moves everything. How do they do it? The one stock, it's all about Boeing. It's all about Boeing. Now, this is something that I was talking a little bit about, like a year ago. And it's been a long time since I've talked about it, but right now, this is the trade, people, that is in play. This is a little slide that I put together. It says it's all about Boeing. Let me explain. Boeing is the single most important company in U.S. equity markets, bar none, hands down. Boeing is 30% year to date. It's up 30% year to date. Now, for those of you, if you're a chart connoisseur, let's go ahead and let's actually throw Boeing into the chart over here. Year to date percentage. It's actually up. There you go, 30%. And I'll just highlight this on the screen for you. So there is Boeing. Right now it's up some 30%. Great. Now, it's up 30%, making it the best performing Dow stock by a very, very wide margin. Boeing also happens to be 10.9% of the Dow Jones Industrial Average, meaning that, the Dow isn't weighted, all right? It's not weighted like the S&P 500 or like the Nasdaq, It has to do with the sheer dollar size of the stock. And Boeing, once again, I'll bring up Boeing so you guys can see it. Boeing is a $424 stock. If you look at the rest of the Dow, and you can look at the Dow simply by going over here to quotes, and this is the Dow. Now, you can look at market cap, but again, when it comes to the Dow, it's not about market cap. It's about the price. And that sounds ridiculous, but that's the reality. And if you take a look at the price of something like Boeing, Boeing's a $424 stock. The next one of the Dow is what? 267. And then it goes down to like 3M, which is like 209. And then Goldman Sachs. And then Home Depot. Like, think about that. Boeing is an absolute monstrosity inside of the Dow. Now, we're getting someplace over here, okay? Boeing is 2.4, okay, times more influential than Apple. It's 3.9 times more critical than Microsoft. And neither Amazon nor Google, they're not even in the running. They're not even in the running. Okay, by the way, these stats are actually provided by a company called TheoTrade. I've known, Nick and Jessica for a couple of years out there. Some great work they put together on this front. Now, here's where things get even interesting. Move Boeing, and you can move the entire marketplace. Given Boeing's 10.9% weight, it's contributed, okay, 776 points to the Dow in 2019. That contribution is more than, okay, the next four names combined, which is Goldman Sachs, IBM, okay, United Technologies, Home Depot. That's a total of 692 points. But I'm saying it's shocking that multiple firms in the Dow, they're not moving it as much as one individual company. Boeing is responsible year to date for 776 points inside of the Dow. Again, these five names, if you combined all five of these, are responsible, okay, for 56% of the Dow gains year to date. So you got to think about this for a second. If you want to game the system right now, all you have to do is drive order flow. Drive order flow to where? Drive order flow to Boeing. Drive order flow to Boeing, turn around, buy some Goldman Sachs, drive order flow into Home Depot. Why? Because actually you can drive, okay, the Dow. If you can drive the Dow, you can drive the S&Ps. Who's driving the bus now? Think about this for a second. And you thought a 747 was big. Boeing is directly responsible for 30% of the Dow's advance on a year-to-date basis. And this is the stuff that people, they just don't get about markets right now. Okay, it is the most influential stock in the entire marketplace because, as I said a moment ago, all right, if you had a little bit of an understanding of what I was talking about with this idea of statistical arbitrage, if you can move the Dow, you can move the S&Ps, you can move the entire marketplace. And even big market cap like an Amazon or a big market cap like, Apple, okay, again, they pale in comparison to what Boeing can do to drive that marketplace. Why, okay, do I discuss this? Because we're in a really similar situation. Like, why bring this up now? It's a very, very similar situation. I'm going to open up a 3-year chart, okay, to what we actually saw coming into what? This is actually late 2017, right into 2018, okay? And again, Boeing saw some tumultuous volatility, broke down, exploded once again higher. Okay, this is a phenomenal move. The question is, okay, when does it now run out of gas? When does this thing actually run out of gas? It's going to be the most influential stock to the upside. Unequivocally, though, there is too much risk. And the reason for me kind of delineating this, the reason for me spending a huge portion of this weekend's update on this, you have to recognize, okay, whether you're a retail client, whether you're managing a hedge fund, or whether you're managing several $billion, okay, of funds, when one stock, okay, can drive order flow, we are not in a good place in this marketplace. All right, we're not even close to a good place because if you think about this, and again, it's not supposed to work this way, people. It's not supposed to work, okay, when you have a $400 product, when you're trading less than 4 million shares a day, and that one product can actually drive the entire marketplace higher. We're in a no liquidity situation. Forget about low liquidity. There's no liquidity driving into this, right? This is minimal amounts of capital that can actually drive Boeing higher. And yet by driving Boeing higher, we can drive the entire marketplace higher. We are hanging on right now, a marketplace, okay, by a wing and a prayer. The risk that stands in the marketplace is phenomenal. This is not me standing here saying like, I'm really, really bearish in the marketplace. This is talking about the liquidity issues in the marketplace, how fragile the structure of a marketplace has become when, again, firms learn how to game a system by driving algorithms into one individual stock and thereby driving the entire marketplace. The last thing I'm going to leave you with on this weekend's update over here, we're not going to go through the normal, okay? Last thing I'm going to leave you with, and I thought this was quite interesting. I have been watching ETF fund flows, okay, really substantially in like the last 6 months. But one of the most interesting things, and again, this is just some food for thought, one of the most interesting things, this is pretty much, okay, almost year to date, right? I'm like a day or two shy of year to date. Take a look, all right? This is top 10 redemptions, okay? Top 10 basically what? Capital flowing in, this is capital flowing out. Just make it really clear. Do you realize products like the spiders, okay, have net outflows amounting to over 12 billion? Okay, this is also S&P 500. So if you add them up, they're basically both S&P 500, right? Okay, you add them up, what do you have? All right, you're net, in the neighborhood of about $19 billion of outflows. Throw a little IWM in there. Okay, it just goes on and on and on and on. The outflows of the marketplace right now, the ETF marketplace, are shocking. And what's even more shocking right now is where capital is flowing into is things like emerging markets. It doesn't speak well of the dollar, I would think, at this point. And you've actually got people going back towards like what? Bonds like the TLT? Really? Okay, they're going back into things like the TLT. Again, it speaks volumes because you have to look at the marketplace right now, and the entire marketplace is in stark contrast again to what you're seeing. All right, the ETFs, that's definitive. Like people are pulling capital out of the S&P 500. All right, the spiders, but the spiders are still going up. How can that possibly be? Well, just like I showed you with arbitrage, somebody's buying something. I'll tell you what's going on. The only thing driving markets right now are likely stock buybacks. Okay, likely stock buybacks, and as they buy back stock, okay, these markets drive a little higher. Could be actually a little bit of a short squeeze as well. Nevertheless, okay, that coupled with Boeing over here is a whole lot of risk in these markets. I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.